Hi, this is James Fong. Welcome to ACCA Lectures. Today we will talk about SBR, which is the Strategic Business Reporting, and we will focus on the Conceptual Framework. Hope you enjoyed it. Okay, so we're gonna talk about the first chapter today, frameworks. So this is the largest companies in the world in 2020. So as you can see, the biggest part, this is all the United States companies. So we're studying ACCA because we want to know more about IFRS, but you need to know that most of the the biggest companies in the world are using USGAAP. They are not using IFRS, although IFRS is an international accepted GAAP, and also IFRS is a principle-based and accepted by 120 countries. But you have to know that in the real world, it's not just IFRS and US GAAPs. They are the one biggest, the largest company is using US GAAPs. Okay, and this is the Europe. Europe use IFRS, as you can see, and this is Asia, and this is the market cap of all these companies. So in Asia, the biggest company is Saudi Aramco. This is the Saudi petroleum company, and then we got a lot of Chinese banks. We got Tencent and Alibaba, but this is 2020. Right now, the market cap is much lower than this. So this is what I'm talking about, because in the real world, we have both IFRS and US GAAP, and of course we got Chinese GAAP, but Chinese GAAP is 99% the same as IFRS. So but US GAAP is different, but similar as well, also very similar. So who are ACCA-SBR? The ACCA headquartered in London and develops and approves IFRS. So this is we are the one we are talking about in ACCA lecture and exams. So ACCA was formed in 2001 and replaced IASC. So IASC is a very old commission, a very old committee, and so the mission is to promote convergence on a single set of high-quality, standardizable, and enforceable global accounting standard. So they're trying to unite every standard, every country GAAPs into a one big principle-based accounting standard. This is difficult, but this does mean something, right? So especially in the lots of countries like Hong Kong or Southeast Asia and a lot of other countries, they just copy what IFRS updated. So they are using 100% IFRS. Okay, so that is why it is important to learn about IFRS, because if you do understand IFRS and you are already access to the GAAP of lots of countries. Okay, and then for US GAAP we have FASTB. So FASTB is the Financial Accounting Standard Board, and it is an independent private sector, and it's a non-for-profit organization. It's headquartered in Norwalk, Connecticut. So FASTB defines US GAAP, which is the rules-based GAAP. And actually, these two committee has have a relationship because they from 2014 these two works together. They're trying to make sure the IFRS and USGAAP are getting closer and closer, and eventually they want to have a unified accounting standard. But we both know that it's not going to happen because USGAAP is dominated by the biggest company in the world, so it's difficult. So they define the accounting standard, not the accounting standard define them. So that would be difficult. Okay. So for FASTB, it's for IFRS, it's over 120 countries already permitted the use of IFRS, and entities in the US, they use USGAAP, but SEC allow certain international companies, if you want to go public in NASDAQ or US, other boards in US, you can use IFRS. Okay, so this is the updated of these two. And for FASTB, FASTB is under SEC, US SEC, and the FASTB define the gap. And you may also heard of PCAOB. PCAOB is created by the very famous Sarbanes-Oxley Act. When after there's many accounting scandals in earlier 2000, so PCAOB defines accounting standard, quality control standard, ethics independence standard, and other standards. So, and also you will, if you have learned financial management, you will know that there's a very famous Conceptual Framework for internal control, and that was created by PCAOB as well. Okay, so we got PCAOB and FASTB. This is how it works in the United States. And for IFRS, which is simple, we only got IFRS define all the IFRS. So right now, this is we got a preference to IFRS standard. We got a conceptual framework for financial reporting, and we have a very comparatively old standard, from standard number 1 to standard IAS 41, agricultural. So this is defined by the very old committee ISAC from 1973 to 2001, and then ISAC was replaced by ASB, and since 2001, ASB is the only one define IFRS. So we got some new accounting standard from IFRS 1 to IFRS 17. So this is why international accounting standards looks weird, because we got IAS and IFRS at the same time, because they are the very old principles and the very new standards. But don't worry about the name. I think we're gonna talk about almost most of the topics in our 6 days lecture, so you will be very familiar with this. And also in the examination, if you can mention that the question is all about IFRS 10 or IFRS 9 or IAS 40, so that would be giving you an extra 0.5 marks if you can mention it. And if you Also talked about the criteria or the definitions. You can have the full marks on the on those questions. I think this is very easy marks. Okay, and comparatively, we have USGAAP. It's called Accounting Standards Codifications. So it's named by ASC, and for each of the standards, we got so many clouds or so many definitions because it's a rule-based standard. That means they have to define everything, right? They define everything, and they talk about all the scenarios, all the cases. So that makes them a lot. So and also there are ASUs. So ASU is Accounting Standards Update. So it's not an authorized USGAAP. It's an update, and but once it's authorized, it will be part of the ASC. Okay, so here's the IFRS standard. So IFRS standard include IFRS and IAS. So the difference between them we've been talking about is as the IAS is very old standards and IFRS is comparatively new standard. But we have more than that. We have IFRIC, International Financial Reporting Interpretations Committee, which is the interpretative body of the ACCA since 2001. So they will issue articles, and they will issue interpretations to further talk about IFRS, or talk about something that is not mentioned in IFRS, or it's not clear in IFRS. So they make those interpretations, and we have a few SIC interpretations. So similarly, ISC is the interpretations committee of the very old IASC. So the difference is ISC is old and IFRIC is new. Okay. And this is all the interpretations we have right now. So most of the very old SIC interpretations has been superseded or withdrawn. So I only got about 5 of them still there. But as you can see, it's 3 of them are very old, and we got 23 IFRS interpretations, and within those, some of them are also superseded. But in our ACCA examinations, it won't be tested. So it's just letting you know that IFRS is not just IFRS. It has IFRS and AFRIC interpretations. Okay, so here we're gonna you have the note textbook already. You can turn to your first page. Okay, so this is the conceptual framework for your financial reporting, and the conceptual framework is the principle of everything, right? So when ISB is developing new IFRS, so they have to think about the principles, the conceptual framework. They have to think about that, before they develop new IFRS or they update any IFRS. And in case there are no IFRS in place, for example, for some kind of new business activities like cryptocurrencies, ICOs, some other new business activities, accounting standards very slow. They need to be discussed, they need to be approved and waited until 1 or 2 years before it can take effective. But before IFRS is in place, you have to come back to the very basic principles, to the conceptual frameworks, to think about that. So how should we do to accountingly treat those activities? So this is the this is why we need the conceptual framework for financial reporting. And the first one is issued in September 2010, and it was revised in March 2018. So IFRS is a principle-based standard. So the conceptual framework is the principles and concepts that underlie the preparation and the presentation of financial statement. Okay, so for the framework, the framework for the presentation and preparation of financial statement, it was very originally issued in 1989, and then 2004. So IFRS had a joint project with FASTB. So they need to share the same ideas about the conceptual framework. And then in 2012, IFRS restarted the project. Okay, and they issued DP, they issued ED in 2014, and then they revised the conceptual framework published in 2018. Okay, so this is it is a very old framework, and as it has been updated. Now it is pretty new because there are a few new conception added into the framework. Okay, so in this chapter we'll talk about the element of the financial statement, and how we representation and disclose everything, the requirement. Okay, the objective of financial reporting. So this is about the readers of the financial statement. So who is going to use the financial statement, and who are we trying to communicate by issuing the financial statement? Okay, so those people would be our current and potential investor, the lenders, and other creditors. Okay, and they need the financial statement to make decisions, to allocate the business resources, to make sure the investment or their money is in good hands, right? And so that is why we have the financial statement, including our financial positions, our performance, equity movement, cash flow, okay, something like that, because they need to know our position is like how much asset, liability, and equity we got. They took picture at the beginning of the period and at the end of the period. And then during the period, they need to evaluate, are we performing well by revenue, income, expenses, our profit, and also the cash flow, especially the free cash flow. This is the objective of financial statement, because you need to know what are the readers looking for, right? And for a good quality financial statement, that means we need a good quality information. So how we define the information is good, right? So we got a fundamental characteristics like relevant. We provide only relevant information. So the materiality and only relevant information will influence economic decision of users. So how we define the relevant? That means, to me, that means no more and no less, right? You don't disclose too much in details information, and which the users cannot even find where it is. And you have to disclose all the necessary, important information that users is looking for. Okay, and then we have to disclose the faithful representation. For example, it have to be complete, neutral, and free from error. That means everything you provided has to be in good shape, in good format. Everything is there. And all correct, right? So this would be the fundamental characteristics we need to provide, and that would be the basic quality requirement. So how we can provide a best quality, or at least a qualified financial statement? We need to make it comparable year on year. Like you can compare it to my historical performance, my previous year's financial positions, and also you can compare it to between different companies in the same industry. Okay, and it has to be timely. Okay, and that means look, we already have a very old information. For example, for the annual report, when the readers have the financial report on hand, it's already in April the next year. So that means it's already 4 months later. So we need to provide a very updated information, because in 4 months time everything can happen, right? And it has to be verifiable, because they need to look right, faithful. So we don't like financial reports having lots of contradictions within itself, or the numbers doesn't look right, or it doesn't make sense, it's not logical. So all those this kind of reports is not qualified, right? And we need understandability. It has to be clear, has to be concise, okay, simplified. Okay, for simplifications, I think you guys can find the annual report of Apple. I think their financial statement is very simplified, although they are one of the biggest company in the world, but their financial statement is very simplified, very handy. Okay, and then it has to be cost constraint. That means you should compare the cost and benefit. Okay, so this is the qualitative characteristics of a useful financial information. And for the component, the element of the financial statement, I think you all have those in your mind, like asset, liability, core, equity, income, expense, and also statement of financial positions, statements of financial performance, which is the PL, and other statements such as statement of cash flows and notes. Okay, but you have to pay attention that everything we talk about in IFRS is based on going concern assumption. If the going concern is not certain, or you have doubt, or there's strong evidence showing that the company is not a going concern, then you don't use IFRS. Okay, don't use IFRS if it's not a going concern. But IFRS never mentioned if you are not a going concern, which kind of frameworks or which kind of reporting method you're gonna do. You have to mess it. You have to figure it out by yourself. Okay, I think we'll talk about the going concern later. I'll show you how other company do when they are not going concern, but it's definitely not IFRS. Okay, and then for reporting entity, we don't actually, IFRS doesn't define the combined financial statement, because it has to be some relationship between the two entities. Otherwise, we're not combining it. And regularly, we combine or we consolidate parent and subsidiaries in one consolidated statement. And also we provide the single financial statement for the parent company. Okay, for the economy resources, we got a financial, we got asset, and economy claims, we got liability, we got equity. So the difference between liability is that someone is you have an obligation to someone, to a third party, okay, and that obligation is basically for sure, but for equity, it's a residual interest. So you don't have any obligation to pay dividend or pay anything to your shareholder. It's not guaranteed. So that is why when you are studying the financial management, liability, the cost of liability is low, while the cost of equity fund is high, because equity investors, they took higher risk, because there could be nothing in return, and they can lose everything. That is why they ask more. The cost is more, they ask more, because the risk and reward should be matched. Okay, and income and expenses are describing the increase in asset or decreases in liability, or decrease in asset or increase in liability. These two are basically, we call it the performance. How good are you doing well to increase the wealth of shareholder, and this is the element of our financial statement. Okay, so this is the going concern. As we mentioned, if it's not a going concern, if you have doubt or there's strong evidence showing that your company is not a going concern, you don't use IFRS. Okay, but what if I don't use IFRS? What should we do? Okay, for example, for how we measure our assets. So for non-financial assets may be stated at an amount which is greater than its NRV, provided that it is no greater than its RA. So it's not there's not a standard showing you how to measure a non-going concern company. You need to figure it out yourself. You can use the replacement cost. You can use something like this, the recoverable amount. And for liabilities, for going concern liabilities, you recognize the full amount, 100% the liability, right? But if you are not a going concern, so on day one, you only recognize a part of your liability, right? Because it is the fact already you are not paying in full. You are paying only part of your liability. So that is in a totally different world if you are not a going concern. So that is why so just bear in mind that it's if it's not a going concern, then don't use IFRS. Okay. And okay, and we got recognition. So we need to meet the definition of each element. We will talk about every element in these 6 days, and also there are uncertainties about the existence of element. So to deal with that, we have IFRS 37, provisions, contingent liability and contingent assets. So for contingent liability and contingent assets, we don't recognize those on our financial statement, but we, in most of the time, we have to disclose them in the notes. Okay, but for provisions, it's part of our financial statement because it's it has the probability to of the obligation. And derecognizations, that means we need to remove all asset or liability. So when we lost control of an asset or has no present obligation of the liability, we need to get rid of them out of our financial statement. That's called a derecognition. And in case the exposure is still there, then we have to keep recognizing it. Okay. And then for measurement, we have different ways to measure those elements. We have historical cost, current value. For current value, which means it's more close. It's more close to the market value. So that means the fair value, value in use, or current cost. And in most of the cases, IFRS give us the options between those measurements. For example, you can use the cost model or fair value model for your investment property. So we have those choice, but it's not like we can choose that freely. You have to choose it to better reflect the nature, the characteristic of your asset or liability. It should have to be useful, right? And then we got effective presentation and the disclosure. IFRS is not a very detailed standard. So it just gives you a guidance or a standardized format. But as an individual entity, you can define how you represent those items. It can be how it can be part of your integrated financial report. Okay, and classifications. We need to separate asset and liability. I got two examples here. One is the long-term loan. So for a long-term loan, part of it could be due within 1 year, within the next 12 months. So you have to take that part out of your long-term liability and put those as a current liability, because it's gonna be due in 1 year. Another example is that for cash in bank and overdraft, we in balance sheet we don't offset them, because overdraft is your liability and cash in bank is your cash, so we don't net them. So that would be how we separate asset and liability. Also for AR and AP, receivables and payables, and DTA and DTL, right? The deferred tax asset and deferred tax liability. So it's very unlikely we can offset them. Okay, next it's called aggregation. So we summarize everything. We summarize similar items to give our users a clear information, a simple information, not bothering them by too much details. Okay. So for P&L, they could be heavily aggregated, but you can disclose everything in detail in note, whatever you want, as detailed as you can in the note. But on the financial statement, you have to keep those data very clean and concise. Okay. And then we got a profit or loss and OCI. Okay. So for OCI, certain items will be measured in gain and loss will be measured in OCI. That means it doesn't go to PL. It goes directly to equity. And some of those OCI stays in OCI forever, and some of those OCI will be recycled, will be transferred to P&L when we dispose them. So you have to be sure which OCI may be recycled and which OCI may not be recycled. So for those non-recycled OCI, that means the gain and loss never showed up in your P&L. So that is very interesting part. Okay. And for example, why we have an OCI? So for example, entity A choose a revaluation model in IAS 16 PPE, right? And there's one day the value increased by 50 million, and those will be recognized in OCI. So why it goes to OCI, not the P&L? Okay, because the PPE is not hold for trade, so and will be used for more than one period. So the 50 million gain in P&L would not offer a faithful representation. So that means we're not selling the PPE now. So the fair value goes up and down, or goes up and up year on year, but we don't have to realize it each time in the P&L, because that will make the profit very fluctuated. So we put those in OCI to keep our P&L flat. And then when you dispose the PPE, it depends. Sometimes we realize it in P&L, realize it in profit. Sometimes we just keep those in OCI. They will never be realized as a profit. So for example, here's how we represent everything. This is the financial statement of BP, and it looks nice, right? We got a balance sheet, we got very clean, all the necessary items, and group an income statement, group statement of comprehensive income. So comprehensive income means you got the profit plus your OCI, and you got a total comprehensive income, TCI. So profit plus OCI is your TCI. So and TCI is showed up in a comprehensive income. And we got a group statement of changes in the equity, group cash flow statement. So those are very standardized format of financial statement. Okay, so for the frameworks, there's advantages and of course drawbacks. So it's been criticized by the following aspect. For example, the historical information, financial information only reflect the past. It could be 4 months ago, but if you are a financial investor and you have a very out of date financial statement on your hand, it's not helping you to make the investment decision right now, because it's too old. It's 4 months ago. And also unrecognized assets and liabilities, because, for example, internal generated goodwill, reputation, human resource skills, no doubt they are part of our asset, but financially we don't recognize those, especially for those internal and tangible assets. Okay, and IFRS is I think IFRS is even more friendly than USGAAP. For example, for the R&D, at least IFRS can capitalize part of your R&D expense if some criteria were met. But USGAAP R&D expense, they're all gonna expensed. There's no capitalization for R&D in USGAAP. Okay, so this is the criticism, and we got more and more disclosure that makes it harder to read, and long-term success not reflected. For example, the corporate governance, risk management, sustainability, but it's been improved because currently all the listed company is publishing the integrated report. Those CGRM, sustainability or ESG reports, they're all included. This has been improved. For estimates is a big problem, because for accounting you have to estimate your depreciations, right? For example, if you are a hydroelectric power station, all the about 80% of your total asset is fixed asset. So that means about maybe 80% of your cost is depreciations. So how you make the estimations? Is it right? Nobody knows. Is it right? It's like for the 50 years depreciations. Is it correct? Is it fair? No, of course it's not. So that is why estimates is evil, right? And then we got a professional judgment. Judgment is required by lessors when classifying a lease as a financial lease or operating lease. So for lease, we need those judgment. And then we got use of historical cost. For PPE, as an example, we can choose the cost model or the revaluation model. If we choose a cost model, the carrying value will be in a very low amount after all these years, it's still the very original price. And this could mislead users about the true value of the company. And also policy choice. There's we can choose cost and fair value, and that makes it harder to compare like for like, because for company A, they use cost model. For company B, which is in the same industry and could be even could be a competitor, they use fair value. So it's not easy to compare now.